Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm Tom Shawcross, licensed agent with Second City Real Estate. With me, as always, is Mark Ainley, co-founder and owner of GC Realty. Mark, what do you want our listeners to do to that subscribe button?
Smash that subscribe button and give a whole bunch of likes and give us some 5-star reviews. We're not seeing them go up. So that means you guys aren't listening to us specifically. So I'm basically screaming at the top of my lungs for you to give us reviews and smash stuff. So please go and do that. That's what keeps our ratings and our the spread of the word of the show online going. So please, we need your help. I know there's a lot of people that tell me on a daily basis how much you like our show. Please make sure you're sharing with friends, reviewing us, referring us, all that stuff. So that's the help we need from you guys out there. That's
how we get guests like today, right? The first thing their publicist or their marketing person does is ask those questions. That's why it's important to us. I just want to throw that why out there. Like, we want to get the big time hitters. That's like the entry level stuff that we need to have as our ammunition.
Yeah. Today's show is somebody that has information that you need to understand as a listener, as an investor here in Chicago. Like, there's so much great information that came out of today's show that is just so, I learned a bunch of stuff today.
Yeah, absolutely. And a huge shout out to Mike Lasser and the MBOA for making this connection. Always a friend of the show. I know we went through like a 2-month span where we just said, thank you, Mike Lasser. We're back on that train now. Which brings up, we'll post it to our website, but we have the coming up in August, we have the MBOA soiree. Windy City team, I know they have their event in mid-July. So we'll have all that posted on our website, but actual in-person networking events, they're coming back. And by the time this airs, we would have had ours already. Go out there, start meeting people, get face to face.
Awesome.
Mark, let's jump right in. What do we got for housing provider tip of the week?
All right. So housing provider tip of the week. I have a lot of people that come to me asking me about 1031 exchange and they're selling a property and they have to roll it in because they don't want to pay taxes and so forth. But I'm starting to see a lot of people that are considering overpaying for a property just to save on the taxes when they might pay 30 or 40 grand more for a property than they should be, trying to save 20 grand in taxes. And that doesn't always make sense. So I just want you to make sure that when you're evaluating your exit strategy or your rollover, your 1031 considerations, that it makes sense. Because it's really, I'll pay $10,000 taxes and do something else with that money versus buy a property that's 40 or 50 grand overpriced, which is a lot of what we're seeing right now. Now, keep in mind your mindset, and you have to step outside of it. When you are usually looking to place your 1031 money, you're rushed, you're hurried, and sometimes those make you look at deals differently. So you just have to be very
disciplined.
Make sure. Yeah, discipline. Discipline's a great word for that. You have to be very disciplined and make sure what you're trying to save is not less than what you're about to overpay for.
Yeah, I can absolutely relate to that. Like, even with the flips, it's like if you're sitting there and you're heavy on money, you're like, we could take this deal. It's marginal, but we're sitting on cash. Let's do it. It's not the right attitude, right? Like it's not the right attitude. Everything still has to make sense. Also, the other thing, going back to 1031, you're just deferring that obligation. Right. It doesn't just magically disappear as well. It's still a great tool. It's still, and if you can do it, great, but you should not force the issue. Just go ahead and eat your fee or whatever. In this grand scheme of things, that's a much smaller price to pay than forcing a bad deal.
Yeah. A lot of people I'm talking to these conversations, they haven't talked to their CPA yet. They've already talked to the 1031 exchange person, or they have this whole plan of how they're going to handle it on calendar of what they have to do. But they're not even sure what their tax consequences would even be if they sold the property outright. So it's important to understand, everyday person, a lot of people, even myself, a lot of times don't understand what your real tax liability is after all the write-offs, the expenses, the depreciation factors, like all that stuff. So make sure you know what you're up against. Make sure you have your CPA, your accountant in on the conversation from the get-go before he or she is the person that's probably recommending you consider a 1031, if anybody.
Yeah, I dig it. All right. We have a special guest today. This one took some hunting down. We are very excited. But our guest today, born and raised in Hyde Park, proud graduate of Kenwood Academy. He spent more than 20 years valuing assets as a mutual fund portfolio manager and analyst, helping average families save for retirement. He's here with us today because in 2018, he was elected as the Cook County Assessor to bring fairness, ethics, and transparency to the Cook County Assessor's Office, with a vision to focus on technological upgrades and elimination of favoritism. It's one of the hottest topics to cover, so let's go ahead and dive in. Fritz Kaegi, welcome to the show. Fritz, how are we doing today?
Doing great, Tom. Glad to be here. Glad to be here with the viewers here. Looking forward to it.
Yeah, this will be exciting. So really appreciate your time. Really appreciate Scott in your office setting this up. Before jumping in, just a little background on being an assessor. It's a tough job, right? It's like being, in my head, like being a referee or an umpire. No matter what, you're going to upset somebody. So what attracted you to this position in the first place?
Well, thanks, Tom. I talk to my peers around the country, and one of the truisms that they have is no one was ever born wanting to be an assessor. So everyone has kind of a unique path to getting here. I'd been in private markets and financial markets before I came into this, and I really had a good knowledge of the valuation process. I like the stewardship that came from my old job in investing people's savings, putting their needs above my own. But what I saw growing up in Hyde Park and having a lot of friends and classmates who were started to become homeowners on the South Side and in the Southland is that the system was really messed up. I saw this when the housing crisis was hitting. Their home values were going down as much as 50% in some places. Many of them were underwater on their mortgages, but their tax bills were going up. And I didn't understand that. That didn't make sense to me. I always thought that a change in your property value should lead to a direct percentage change in your tax bill. But then I learned how this system works. And then I realized it's a zero-sum system where they determine in advance how much property tax has to be raised. And then we use assessments to divvy up that bill amongst all the property owners. And if we're at the assessor's office and at the Board of Review, if we're messing up the value of individual properties, then that is conferring a favor or a punishment onto to people by having an unfair share of the burden. And so that's why I thought I could do a better job in this. I thought we really needed someone who could impartially call these values, regardless of what kind of property you own, use better data, eliminate favoritism from the office. And I thought this would be good because it had to do with the equity of our property tax system, which is so important to the vitality of the communities that I grew up in and care about all over the county. So that's why I did that. That's why I do this. And I really like it because, we're making an impact on something that needs change. The state needs good government and economic equity and a better economic climate. And we think we're providing all of those things.
Yep. No, that's great. So let's talk a little bit about how we actually calculate tax bills. Cause I don't think all of our listeners understand that. Cause we hear a lot, my assessment doubled. That means my tax bill is going to double, which is not necessarily true. So Can you talk us through that zero sum that you would
it's actually almost always not true that a change in your assessment leads to the same change in your tax bill. Actually, oftentimes we can have the opposite. Your assessment can go up, but your bill can go down. That's happened to hundreds of thousands of people in our administration. So let's talk about this. The way our system works in Illinois is different from most other states. Most other states, you have fixed rates, which are put in place called millage rates. You apply that millage rate to your assessment, presto chango, you got your tax bill. And if local assessed values are going up, then revenues go up too. That's not the way it works in Illinois. In Illinois, we do it the other way around. Our taxing bodies determine how much money has to be raised every year. What's a taxing body? It's mostly schools. It's about 70% of property taxes collected in Cook County are for schooling. Educating our children, but it's also your villages, your towns, your cities. It's your school boards, your libraries, your forest preserves, the water cleanup, all that stuff. That's added up into something called a levy. It's about $16 billion that are collected in Cook County every year. And in each community that you're in, it's kind of like the dinner bill at the end of dinner. Okay. And we all have to split. We're all sitting around the table in each community and we're dividing up what's our share of the bill that has to be paid for these taxing bodies every year. That's why we do assessments, not because they're fun, but so that the bill is divvied up fairly in accordance with the law. That process is driven by our estimates of market value at this office. So we estimate the market value of every single property so that we can divvy up that bill fairly. No matter how we do assessments, doesn't change how much money is collected in total, but what it does is affect your share of that bill. And so it's really important that the assessor and the board review, which affects the assessments, that we are accurately estimating the value of all properties and not conferring a favor on some. Because if one person who got that dinner tab had ordered a 40-ounce steak and their share of the bill is less than that steak's share of the bill, we're passing on some of the bill to the person who ordered the side salad. And that's not how the system should work. So for the system to be equitable, we need to make sure that these estimates of value are fair to everyone. So a lot of time people, they bring complaints about overtaxation in the system to me, which is understandable, but I don't determine how much taxes are collected. I'm just determining each person's share of that bill that has to be paid.
So you're kind of in between a rock and a hard spot. Like that's you're not in control of what you have to charge, which you usually get the rap for that, right?
And we don't charge anyone actually. All we do is we're estimating property value.
So you get the bad rap for having to do everything you do, because like Tom said, it's you always make someone out, but you get basically delivered at the beginning of the process the expenses of the entire county, and you have to figure out what's the best way to divvy that up. Am I understand that right?
Well, it's not even like that. It's literally our only job is to estimate the market value of properties. Then the board review can look at our assessments and they make changes through their own appeals process. Then the assessed values are then given to the county clerk, which looks at all those levies, and they determine the rates. And then those rates are applied to every single assessed value, and the treasurer sends out the bills to people. So we don't collect bills, we don't send out bills, we don't calculate rates. We just estimate the values of property. We also apply exemptions. But for most of the people watching this show, our job is deceptively simple. It's just to estimate the value of every single property accurately, fairly, uniformly.
So the total bill though for the county, like that if that was less, then you'd have a smaller amount to have to split up and spread out against everyone fairly. Right?
That's right. That's right. So I mean, it wouldn't change our work if the amount of money that had to be collected was cut by 50%. Wouldn't change our work. We'd still have to estimate the value of properties. We'd still have to split up that bill, but then the clerk would be calculating rates that would be lower. And then the treasurer would be collecting half the amount of money in total that they would before.
Gotcha. Just like to figure out root cause there.
Yeah. So, I mean, guys, one of the things that I was blown away by when I came into this office was how even policymakers and elected officials who are steeped in making this law and making these rules and applying these taxes every year, even they don't understand the system, and real estate people didn't understand the system either. So if these people who are really deep in this stuff, if they don't understand it, how is the average person or person who comes from outside of Cook County supposed to understand it? So that is one of the things that we're up against in trying to make the system more simple, understandable. And like when I talk to people, like oftentimes they want to vent, and I understand it, but I try to bring them back to, hey, here all we're trying to do is estimate the value of properties. So bring data. Show us, how if you think we're estimating values wrong, or you have a different way of looking at the market that you can show us. Like that's how we can have a good conversation. A lot of times people they've got beefs about taxation, which are totally appropriate, but like it's not, Mark, I don't have much more to do with the amount of tax that's raised in the county than you do. I remind people of that. Like we can be on the same side of that debate. We're just trying to divvy up fairly and equitably, that bill that's been determined by others, so that the system is as fair as possible.
Yeah, I often try to stick up for your department. Like it's not you that's really in charge of the gross amount. It's the people making the budgets or not making the cuts that should be making cut around the county that you're just dealt. You have to make best of what you're dealt, that hand you're dealt with.
Yeah, and we use the platform of our office to remind people and to elevate these issues, to say, hey, here are some ways that we can reduce the burdens on all property owners from this system. Like there are ways that we can get other revenue streams into our taxing bodies so that they don't have to rely on property taxes, so that we don't have the distortions that come from property taxes. Property taxes are a very regressive way to raise revenue. becoming more regressive as our economy gets more digital. I mean, when you think about it, there's this whole part of the economy that is digital, that's service-based, that gets a pass on paying for all these services, while the people who are investing in brick and mortar have to cover that. And that's pretty inappropriate. That like is kind of putting our state is like, tilting against the people who are investing in brick and mortar that give employment and vitality to our communities and keep people here. I would prefer it if we were raising revenues more through incomes, and then we would be agnostic as to how income was generated, whether it was generated through brick and mortar or digital or some kind of service, and that would be more fair.
Yeah, I think everyone here listening to the show owns brick and mortar, so they're nodding their head saying, great. Going back, though, this seems like such a convoluted way to come up with values, right? Like, is there a benefit to the way that Illinois does this compared to other states? Or is it one of those, hey, this is how we've always done it, and we haven't had enough resistance to make a change? Or is there some advantage? Because it seems like a lot of
value
effort
to the way we do the system is that actually it puts controls on how much our taxing bodies can increase their levies every year. We've got like over 1,000 taxing bodies in Cook County alone, I believe. I don't think we'd want to live in a world where those taxing bodies could raise their levies by an unlimited amount every year. There are important controls at the state level that limit how much those levies can be raised every year. And so that's one of the reasons why, we come up with levies first and then assessments after that to determine rates. If we did it the other way around, we could see property taxation like get out of control. The other thing is that, it's good that we have a system that doesn't have caps, because that could further distort our system. There are lots of states that limit the amount of change in assessment that can happen every year, and then it sort of rains down benefits on the people who have the most appreciation of their property and hands bills to people who have the least amount of appreciation or the newer property owners. And I don't think we want to pick winners and losers like that. My belief is the way we can make the system work well is work on the basis of better data, and make it more predictable. I think it'd be better if we didn't have as many appeals venues as we have. We have 4 now. If we reduce it by 1, I think it'd be good. But we know we have work to do here at the assessor's office, which is to make sure that the first assessments we send out are as accurate as possible with best data, being the best mirror to the market we can. We know that sometimes we don't have the right data or enough data to do that as best as we could. So that's what we're really focused on to make the system work better. And we think that if that happens, there'll be more predictability. Eventually, we'll start to get towards where things are in other states, where you have much fewer appeals. Most states, you only have a single-digit percentage of property owners who need to appeal. We'd like to get to that point. We're not there now, but we're going in the right direction. Appeals are down about 1/3 from when we came in. We think that it would be good if we could, what that does is that lets us really focus in on those appeals that we do get to really identify the situations where we've been off the mark and figure out why.
Got it. So you're evaluating so many different properties, right? You have $50,000 single homes and $10 million condos and everything in between. So can you talk about some of those data points you're pulling, right? And also when you're doing commercial and you're probably using some sort of cap rate to come up with a fair market valuation, just, I guess, walk us through that process. You go as deep in the details as you can of just how are you guys coming up with, hey, this neighborhood's a 6 cap, this neighborhood's a 7 cap, because even investors who look at it all day long will disagree on those sort of data points.
Yep. So the ultimate standard that we need to meet is like, think of us as we want to be the best mirror to the market that we can be, no matter what markets we're looking at. And you're right. God's kingdom in the economic landscape of Cook County is incredibly, incredibly diverse. The neighborhoods are so different. The commercial markets are incredibly different, going from warehouses to manufacturing facilities to sausage stands to car washes to everything in between. Apartment buildings are very different from each other. So we want to, as best we can, to reflect the granular diversity that is out there in the real world. We have some constraints on that. So let me just talk to you about how this works. So On the residential side, like typically the benefit to assessing here is we have lots and lots of transactions on the residential side, and it's relatively commodified. Our modelers in data science would say, look, if you give us the footage, the year of construction, the type of construction, and the location, we're going to be able to get it to pretty close to where the value is, plus or minus 15%, if we have the right information about the home. Sometimes we don't have, like when we find that we're off, even the basic data about footage or other changes might be incorrect. So we want to make sure that that data that's going in at the top of the funnel is good, so that when things come out at the bottom of the funnel, it's accurate. We've come a really long way in the last 3 years. Our assessments for homes, for residential homes, are within industry standards. It's been found by the IAAO. In the first year that we came in, preliminary data is pointing the same direction for the subsequent 2 years that we've done. We will be able to grind out and make it even more and more fair and a good reflection of the market as we improve the basic data we have about homes and improve modeling. The hardest part on residential for us is actually condos, because the state limits how we go about the valuation of condos. We have to value the whole condo building, and we don't have any information about the units. So literally, we have to value the square footage of a giant condo building and hope that the articles of association fairly divide the value within the building the way it is on. And sometimes that's not the case. I mean, markets are always adapting. Markets may assign more value to the penthouse or less, depending on where markets are, but sometimes these articles don't adjust with it. So that is one of the things that's frustrating for us, for condo owners. But we have in the end, we have lots of transactions inside of buildings that help to guide us. And so basically residential is the easier part of our work, as long as the characteristic information is good. Now, as we go to the commercial side, commercial is much more diverse, and there are fewer transactions. So you're right. The most important guide to us is thinking about how markets value income streams coming from different kinds of property that earn rental income. That's kind of so when the markets think in terms of cap rates and the capitalization of operating income streams, so too we look to that. And we try to very closely discriminate between different kinds of markets. So we know there are different cap rates for retail on the Mag Mile versus retail in a city commercial corridor. We know there are different cap rates for as you go down the quality spectrum. So something that is a top tier retail asset is way different from single story retail on a commercial strip that's like 100 years old and doesn't get much foot traffic. So, our cap rates can, for retail, it can start at, in the sixes, maybe, and then go all the way down in the double digits. And that's reflecting the market. We're looking at transactions. We're looking at appraisals that are part of CMBS markets. We looked at lots of different data sources to get to where those cap rates are. So we do similar exercise on all sorts of other asset classes. And I think you're asking about apartments. Apartments are one of the more commodified parts of commercial. So when we're looking at apartments, we look at the typical rents, we look at the expense ratios, we look at the occupancy rates, and we look at the cap rates in that market, but we really try to locate apartments on the cap rate spectrum, on the quality spectrum, to come up with their rents and their costs and their cap rates. So we don't want to treat the cap rate on a modern, institutional quality multifamily 200 unit building downtown and compare that with a courtyard 100-year-old building in Rogers Park. Like, we know those are really different, and we want to use appropriate data for each. Our analysts will go out and look at, and they will use CoStar. They will call around. They'll talk to brokers. They'll use all the different sources. People can provide information about their own property before we assess it. These are all the things that go into the mix to figure out, okay, here's the rent assumption we're going to use for this type of asset. Here's the cost ratio for this type of asset. And, when things are off, it often can be the cost ratio. Maybe we haven't sufficiently accounted for the fact that we have a really old building that is much more costly to operate, or it's in a neighborhood where collection rate is lower or something like that. And then we want to make sure that the cap rate's right. And so on apartments, cap rates at the baseline cap rates are pretty well established. We can see these in CMBS filings and, Fan and Fred refinancings and many different transactions that are out there. This might be, in the 5s or the 6s in the city. But then it can go all the way up depending on which neighborhood you're in. And there are some double-digit cap rates in multifamily too, in neighborhoods where it's a lot harder. Cost ratios are higher, cap rates are higher, collection rates are lower, et cetera. So, but we're always, the standards, we're always trying to be the good mirror to the market, using good data, document it. And the good news for everyone out there watching is we show you how we value every single commercial parcel. We started doing this in Chicago. So you can go to our website, you can look at any commercial parcel, see how we came up with the value, what rent we assumed, what occupancy, what cost ratio, what cap rate. And that's part of being transparent. It's also part of being accountable and helping us improve. Like if we're off, we want to know why, and should be identifiable in some of those assumptions to understand why.
Love it. Love it. So I love myself a good spreadsheet. Anyone listening is thinking about how the heck do you manage all that data? Like, what does the behind the scenes systems look like that you guys utilize, and how has that changed over the last decade?
Sure. Well, Mark, we came in here and we came in here with the staff of analysts who had good skills. They weren't always used or trusted by my predecessor. So we wanted to make the best use of them. And we think we've improved their work by giving them new top-level executives who have experience in commercial real estate in places like CBRE, working for good appraisal firms like Cohn Resnick, people who've been lenders. So that's who is leading our valuation team. And then we've brought in all sorts of new valuation tools that we didn't have before. Before we had CoStar, but it wasn't clear if the assessor's office was using that data much. We know CoStar data can in some cases be way off. And so we brought in new sources. We use TREP, which is a very powerful database of CMBS information, commercial mortgage-backed security. So anytime there's an appraisal that's part of a bond filing that's filed with the SEC, this goes into this really rich data that TREP has. It's really good for multifamily and more institutional quality. It helps us establish baselines based on what lenders are using for collateral. We use Bloomberg. We use capital market data that comes from the REIT market that comes to us through Bloomberg. We use sources like Reis. We're subscribing to pretty much every commercial database that's available. And then we've also bootstrapped our own sources of data. So we created something called RPI, which is the real property income and expense form. Every commercial property owner gets a form where they can submit to us information about their rent rolls, their expenses, their occupancy, their other costs, so that people are representing in data to us in advance of the assessment, and we can assemble that together and get a better sense of what the real world looks like out there. And then the last thing that we do is we try to do due diligence sanity tests on this data by calling people to get a sense of, when we were looking at the Mag Mile, when we were reassessing Chicago, we wanted to talk to commercial brokers who are actually out there trying to rent out space in Water Tower and the Mag Mile after the events of 2020, and understand, hey, this is what the data is showing us. Like, is this insane? And ask good questions and assemble this mosaic together. And then we talk as a team about, hey, what are the assumptions that we're using here? Are they consistent with the assumptions we're using elsewhere? And then we document them. And then they all go into those spreadsheets that you can geek out on, Mark. So literally, you can fortify yourself with a sandwich and a whole bunch of coffee and just go through any neighborhood you want to look at and see what kinds of assumptions we made on commercial properties. And it's all out there. This is new this year, so I encourage everyone to take a look. No other assessor's office in America gives you this much to play with.
That's awesome. One quick question. How many pins are in Cook County? Or give me an estimate, a rough.
There's a 1.9 million.
1.9 million numbers you got to figure out.
Yeah, it's the biggest market-based jurisdiction in America. So it's it's a lot. Our peers, the peers that are closest to us in size are that are market-based are Maricopa in the county where Phoenix is, and New York, and they reassess the whole county every year where they are. We're not there yet. We reassess 1/3 of the county every year. So, we've got a ways to go to get to where they are. But this is something that people do elsewhere. So we think we're going to get better and better. And we want to be the leaders in the field in terms of accuracy so that the system is fair for everyone.
Yep. So in that last reassessment, I believe assessed values went up. It was like 30 or 31%. It was 35 billion to 40 something. I'm going to butcher the numbers. A lot of that seems to be geared towards housing providers, right? And who are a lot of our listeners right here. So can you talk through just the mindset of the strategy or the why a lot of that burden went towards, more of the apartment buildings as opposed to residential?
Sure. I mean, what I'd say is that, yes, assessed value was up 31% in the city of Chicago versus where it was in 2018. Now, we don't go into that process with we don't come in saying, hey, this should go up this amount in advance of actually looking at the data. So there's no top down.
Yeah, you don't know if it's 0 or 100 or where.
Right. There's no top down decision on, hey, this is how much values have to go up. Literally, it's looking at all the data that we see, going asset class by asset class, using the data that we see coming from analysts, coming from our models, building up the value, and then we get to the 31%. So it's literally trying to be that good mirror to the market in every single asset class. And that's where we landed. And it's as much a representation of the flaws from where the assessor's office was before as, an actual change in market dynamics over the last 3 years. So we didn't come in with any a priori decision to raise values on one asset class over another. I think if you look at the previous years that we had a reassessment, you'd see oftentimes that multifamily, for whatever reason, was pretty undervalued by this office. Oftentimes, 40, 50% undervalued versus, where the market was. Now, that can be a combination of things. That could be that they were using cap rates that were too high. They were using double-digit cap rates in this office for multifamily in 2018. And I think anyone out there who is a multifamily investor would say that that's not a realistic reflection of market conditions in most neighborhoods as the state of the market was in 2018. There wasn't much discrimination between neighborhoods. So they were using roughly the same cap rate for Lakeview that they were for Englewood. And that's not right either, right? Like, everyone out there will know that investors have to be compensated with a higher cap rate to own a multifamily asset in Englewood versus Lakeview. And it really was putting burdens on the people who did take that risk with more taxes in Englewood by not reflecting that difference in the market. So I want to make sure I don't lose my train of thought here. So that's how we came to multifamily values. Now, I would say within that 31% is a lot of diversity across neighborhoods in Chicago. So, we saw a roughly 60% increase in assessed value in the Loop, but there are a lot of neighborhoods where assessed values, even when you take into account multifamily and commercial, were not up as much. Englewood would be a great example. Commercial values down there were down because they were a little bit over-assessed before. And that reflects, the fact that we are building these valuations from the bottom up, looking at the data, not coming in with any a priori decision on where to move values. And so that's where things came. I think we would generally say that the greatest undervaluation was on the largest commercial properties downtown and in the West Loop. We saw, moderate increases in commercial properties, including multifamily, in many neighborhoods across the city. But there were some neighborhoods where those values did not increase much. You see those especially on the South Side, and that reflects, different initial conditions from where the assessment was in 2018, and fair assessment of where markets were at the start of 21.
Cool. Good answer. Affordable housing is a big topic on our podcast. It's a big topic. You hear it just in the papers or online papers. But do you feel that increased taxes, increased expenses, that's going to just exacerbate the issue with affordable housing? And between the private and public sector, what do you see? How do you see that playing out?
Well, look, we do know that housing affordability is a big issue here in Cook County, as it is in so many other parts of the country. We have a low vacancy rates in rental housing right now. I mean, I think we're kind of at a historic lows in the suburbs and in the city, and so this is a concern. Now, we worked with our partners in the General Assembly to get past the affordable housing omnibus bill in 2021, which basically says to people who were in class 9 before, or who are renovating or building new rental housing, 7 units or more. And it says that, hey, if you are allocating a certain percentage of your units to units that are tied to people's incomes rather than to market rates, you will get assessment reductions that are substantial if you meet those targets. And we think we worked with our partners in the General Assembly. We worked with many different housing groups. We worked with builders and constructors who are interested in this market too. And the bill eventually passed unanimously. We are implementing this bill as our office this year. And it's exciting. We think it's going to stimulate the construction of affordable housing across the city and in the suburbs and places that hasn't had it. I think if you look at the trade press, we're seeing really robust conditions for people who've invested in multifamily and affordable housing. There's lots of projects coming up on the drawing boards. There's lots of transactions happening at eye-popping multiples. Rents are going up quite nicely. This is a good asset class for investors around the world to come here, especially in this time of inflation. You got an inflation protected asset and a good market with sound conditions where pricing's favorable, and good, lots of smart investors, smart money is coming here and building and acquiring, and this new incentive makes it even better.
That's awesome. Yeah. So we were gonna ask about that. You knocked it out already, which is great. I guess, Fritz, before we let you go, and you've covered some of these, but what are some myths or, common, I'll call them untruths, that people assume about the office that you'd want to correct?
Sure. I think the first one is that
you seem way too willing to answer that question. That wasn't even a planned question.
Finally, someone asked me.
You're ready for that one.
When you're a human lightning rod, as I am, whenever you get a chance to sort of to express yourself about some of the things that might be off the mark a little bit, I always will go for that chance.
Hold on, Tom wasn't even done answering that question. You're ready to answer that. That's the funny part.
I think the first one is that people think I like property taxes, that it's like that is good, or and as I mentioned, I think we put too much burden on people who are investing in brick and mortar to fund the things that we need. Really, especially in this time when the economy is becoming more digital, more service oriented, we can't afford to have our fiscal mechanisms all be tied to the value of brick and mortar. Wealth is evolving in this country. Net income flows are evolving. The economy is evolving. So too does our fiscal infrastructure. And I think the more we can get to where we're taxing income, regardless of how it's generated, whether it's generated by brick and mortar or not, the more fair our system will be and more well adapted will be to the challenges of a more digital economy. And we'll keep people here and we'll keep vitality in our neighborhoods. One of the great strengths of Chicago is our vitality, the amazing things that people fill up with our brick and mortar. And I think we got great days ahead. I know like things like LaSalle Street are going to evolve. I think it's going to be really exciting to see how it gets filled up with more residential, become a little bit more like Lower Manhattan. We'll start seeing, multi-story grocery stores that get a flow of people coming around the clock. It'll give stores on LaSalle Street a greater chance to thrive and survive, so they don't just depend on the lunchtime crowd. Like things like this are interesting. I'm a big believer in capitalism, and it will work better if we don't put our fingers on the scales by paying for the things that we need just on people who invest in brick and mortar. So that's one. Two, I think another myth that people really need to keep in mind is the change in your assessed value leads to the same change in your taxes. Absolutely not true. And the reason why, go back to that dinner bill. The dinner bill is fixed. It does grow a couple of percentage points every year. But it's all about what your share of that bill is. And if your assessment's going up 20%, but everyone else's is also going up 20%, your share of the bill is probably not going to be changing very much. So the thing that I encourage people to really look to is to look at how much the overall base in Chicago is changing. So the base in Chicago is changing by 31% now. The board review will make some appeals that may go down somewhat, but that's kind of the baseline for people to think about. If your assessment's going up 10 or 15%, you're probably going to have a lower bill in Chicago come the second half of this year. And that's true of lots of small businesses who might have been expecting their bill to go up. So that's something I really want people to keep in mind. In the city of Chicago, homeowners share the burden down about 9 percentage points in this reassessment of Chicago, with a levy that's about $7.5 billion. That's like more than $600 million a year, on track to be staying in our neighborhoods with homeowners that can be spent on things like local retail. And I think it's going to be really good for our neighborhoods. That's where it should have been all along. Again, this wasn't an a priori decision of us, but that's where the data led us to. And that's the last thing. We do not come in with an a priori decision of who is good and who is bad and who we like and who we don't like. We're trying to follow the data. We're a data-driven office. It should have been like that all along. The benefit of bringing a data-driven assessment system to it is that the system is becoming more fair for the smaller business and homeowner, but it's not an a priori decision about like, hey, I want to take the system here rather than there. It's following the data, and I think that's going to get us to a better place. We've had a lot of change over the last 3 years as we phased in our reassessment of each part of the county. I don't think there's going to be as much change going forward as we've had in the last 3 years for folks who've been subjected to that change. So I encourage everyone who might have had some shell shock by assessments over the last few years to take another look. The things are thriving. Smart money's coming here. We're seeing lots of big transactions happen, not only in apartments and industrial, but in office. We had only the second $1 billion office transaction in the history of Chicago this year with the B of A building. We had a couple chunky other office buildings like the Leo Burnett building, 311 South Wacker. Our assessments were right in line on these buildings, and yet investors are bringing their money here. So, and these are sophisticated money, people from around the world, smart money coming here. So if you felt maybe deterred by uncertainty before, take another look. There are a lot of people who sharpen their pencils and are bringing their money here. So it might be a good time for all of you guys who are sitting on the fence to come in. And I think it's going to really help the people who have been invested here.
Awesome. All right, Fritz, that was awesome. Lots of great information. We're going to run through our wrap-up questions here, and then we will let you get back to your busy day. You ready?
All right. Okay. All right. Well, thanks.
So I'm going to reword this question a little, but what has been your competitive advantage in your seat that you're sitting in now versus any of your predecessors or future potentials?
Well, I think one of my advantages is I came in with a 2-decade private sector investing career, being exposed to the capital markets. And, I saw that, there's more to real estate than maybe what an old-fashioned appraiser might come up with. A lot of these appraisal techniques are a little bit out of date. Just like the world of mortgages was changed a lot by taking, conventional loans and bringing in capital markets. So too, real estate has been changed. Capital markets are really important to real estate markets now. It drives lending, drives the value of equity. We have a lot of good data to work with. And I think that's really helped us here, when I can bring in the capital markets perspective to, maybe some more old-fashioned appraisal techniques that we might have leaned on pretty heavily before. The other thing is, as someone who was not coming up within the assessor's office, we could also bring in modern data science techniques, which is really making our residential modeling better. A lot of old-fashioned residential modeling, it averaged things that should not have been averaged. Like, it would take an average of $ per square feet in Hyde Park and in Woodlawn and sort of mash them together. And that would lead to it being wrong for Hyde Parkers and wrong for people in Woodlawn. And data science is helping us to really have a much more granular view of a block by block view of residential values in a way that like old models just did not measure up, and we're getting really good results with that. So I've been open to that, and we brought that in, and I think that's helped too.
So Fritz, you see a lot of data points. Given all the knowledge you have, what is one piece of advice you would tell someone that is looking to buy their first property in the Chicagoland area?
I would say there's a lot of the bad stuff that you might hear about with, crime and uncertainty and like pensions. All that is priced into the market right now. People who are investing in Chicago are being paid to take that risk. And you get it with the attractive valuations you get in Chicago. I think, I see a lot of smart money, a lot of smart people bring their money here into Chicago. I think for those who might be worried about the fiscal outlook of the city of Chicago and the suburbs, people should take a second look. The municipal bond market is they're bullish on Chicago. The reason why is Chicago has really attended to a lot of its pension problems that we've heard a lot in the past, but they are in the late innings of pretty much stabilizing a lot of the issues with the pension fund. So I think people should take a second look there, because the fiscal condition of our city, also our state, is a lot better than real estate people might have given it credit for. And it's kind of been this universal excuse not to invest in Cook County and Chicago. And I think people who are sharpening their pencil and looking at this are realizing, hey, I'm getting paid to take risk here. These cap rates look pretty attractive compared to coastal markets. I can get paid pretty well for owning assets that are well insulated from inflation. And so I think the setup is really good for Chicago and the Chicago area. One of the historical forces that you can take to the bank over the last century is that global cities and urbanization will keep on propelling global cities like Chicago. Those forces that integrate us globally, that enhance the transportation linkages with the country. I mean, Chicago, you can fly direct to anywhere in the US, you can fly direct internationally. This is a really great thing we have here. We've got a lot of other great assets, good education institutions. You can have critical mass. You can be a couple. One person's working in life science, another work in a completely different sector, and our economy is diverse enough to handle that. So these are good things that are going to keep propelling Chicago forward. I think we will overcome the speed bump of COVID, which has disrupted everyone's life, and those big historical drivers that have always helped Chicago are going to be taken over time.
Awesome.
Love it.
When you're not rolling around in spreadsheets and data, what do you do for fun?
You might see a lot of books in the background here in my library. I love reading history and biography. I've got 3 kids, a 15-year-old, 14-year-old, and 11-year-old, wonderful wife who's a teacher. we love to read and sort of share each other's company with that. That's how I relax.
Nice. All right. So that ties into the next one. And this does not have to be real estate related, but what is a good book or podcast that you would recommend to our listeners?
Oh, wow. There's a really good investing podcast that I like, Ted Seides, as Seides. And I need to get the title of it. I like to listen to it because he's always interviewing good investors, either from the world of endowment. It's called Capital Allocators. And it is a great, I find, and I like investing. I did this for 2 decades. And Ted always has really good people there. He's a really good interviewer. And to me, in my own geeky way, it's a great way to relax. I also, in politics, I'm in politics, so I also listen to Hacks on Tap, which is with David Axelrod and Mike Murphy. Good banter, good high-level discussion of politics. I listen to that every week. In terms of books, I'm a huge fan of Robert Caro, Caro, who wrote a biography of Robert Moses, the guy who basically created modern New York.
New York, yep.
Yeah, called The Power Broker. And he's got a multi-book series on LBJ, which is really about power in the 20th century in America. It is an amazing series, really well written. He does all the work himself. He's basically dedicated his life to these books. He writes one every 7 years or so. We're waiting for him to get the last one out on the presidential administration of LBJ, but he's my favorite biographer.
That Moses guy is amazing. He's like responsible for like the biggest, like all the bridges, the highways, all the infrastructure in the early 1900s.
Yes, fascinating, and a cautionary tale on how someone can start out as a reformer and then like go in like a real power hungry direction that created a lot of damage. So I consider it a cautionary tale, but it helps if you've ever spent any time in New York. I mean, there's no better book to understand why New York is the way it is than that book.
All right. Besides yourself, name one person or resource in your network that you'd highly recommend to other Chicago real estate investors.
Like a person or
a tool, whatever would help our listeners.
Yes.
Something.
I really recommend that people who are looking at Chicago talk to Deputy Mayor Samir Mayakar, who's oversees economic development for the city, and talk to Michael Fosnacht, who heads World Business Chicago. We got some really good people who are rethinking about how Chicago presents itself to the world and attracts investment here. I think they're doing a great job. And I think everyone out there who is thinking about investing here, you will come out better off talking to those guys than you did before. You'll learn something. You'll find some themes or new opportunities there. They're both They have entrepreneurial backgrounds, which is, I think, when you look at our peers in the rest of the world, cities where we have people who are, basically promoting investments, and they're the economic development people. It's people with entrepreneurial backgrounds that are really the best at that. And these two guys are great. So I had the pleasure of hearing Samir speak at a BizNow event probably about a year ago. So it was absolutely just mind blowing, just super sharp dude. So for our listeners out there, the Joe Moores of the world, if you got an in there, we've reached out with no luck. Let's get Samir on the show here. That'd be awesome. Yeah, go for it, guys. I'm sure he'd be happy to speak to the whole audience. So Fritz, thank you so much. You provide a ton of value to our listeners. There's just so much to digest here. How can they learn more about you? Is there any way they can provide value to you? Well, so go to our official website. Go to cookcountyassessor.com. We have a wealth of information out there that we think will be useful for everyone for a variety of different uses. If you want to learn about the system overall, we've got information there. But we also have really good information as granular as you want on neighborhoods. We have a whole new dashboard that we publish, so you can get information about what the reassessment of Chicago means for individual neighborhoods. You can dig down into different asset classes, see what changed. Then you can go down to individual parcel level and see how we came up with the value. So this is all there for you. We want to hear your feedback on that, how we could make it better, what is missing, what could be done better. the thing that we want to do as an office is really reach out to those investors and entrepreneurs out there directly, because we've created some tools that we think will save everyone money, make this system work better. But property tax appeals lawyers try to get between us because they make more money the more broken the system is. So we're always trying to reach out directly to those property owners and investors to say, hey, if you submit data to us before we do the assessment, you can probably save yourself money and start off from a better point by getting that information to us, even though your lawyer probably wouldn't want you to do it because it's going to cost him money. So that's another thing I'd remind everyone should check out the real property income and expense form. If you live in the north suburbs, you have a commercial property in the north suburbs, please submit that data to us this year before we come around to sending out reassessments.
Good stuff. So we will link to that in the show notes. Fritz, before we let you leave, we do ask one Chicago fact question. So Mark gets first dibs at it, and then we'll also give you a shot at it. So Mark, I think this one is doable. This isn't super easy, super hard. It's going to be multiple choice. Mark,
1.9 million pins. That's it, right? That's the answer.
Yeah. We already had a great fact in the middle of the episode. All right, so this is going to be based on 2019 stats. I mentioned our guest today was born in Hyde Park, which is home of the Museum of Science and Industry. Probably one of my favorites, if not my favorite museum that we have here. Based on the last year before COVID, how many guests visited the museum on a daily basis? So I took the overall amount of guests for the year and divided by 365, pretending it was open every day. And your options are 650, 1,100, 3,800, or 7,700. This is the amount of people that walk through the doors of the Museum of Science and Industry on a daily basis.
I would say 1,100.
1,100. Fritz, what do you want to go with?
I'm 7,700.
Oh, you guys split it. 3,800.
All right.
Okay. So 3,800 people on average a day go there, huh? That's crazy.
And it's probably more because I assumed Christmas, like I just divided the number by 365.
Wow.
So in reality, it's
just
probably
try to
like
compare
4,000.
it to the number of people who go to the ballpark. But I guess you got to do this year round. So that makes sense.
Yeah.
That's great. Fritz, thank you very much for coming on. We look forward to having you back on here. Yeah, because there's a lot of stuff we didn't go over. Tom, thank you as always. Listeners, please leave us a review. Make sure you leave us a 5-star review. Please subscribe to our YouTube page and check out our resources page on straightupchicagoinvestor.com that we just updated with some additional good information to add value to you guys in your investing career. Fritz,
thanks, Tom and Mark. Happy to come back anytime. And thanks everyone out there for being with us.
We'll see you all next week.
Awesome. See you all.
All right. See you later, guys.